Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, July 29th, 2020. I'm Jay Gragnani, and here joining me this week is Ian Saunders. And we're winding down now the month of July, just a couple trading sessions left in the month, and in a month that is historically a quiet one for the market. Certainly has not been quiet with everything still going on in the market, and everything from the vaccine news that we're continuing to monitor. We had Fed come out today with keeping interest rates low, and then continually still seeing some companies coming out and reporting quarterly earnings. So a lot of news still coming out, and given the environment that we're in, a month that is historically relatively quiet is one that certainly has not been, and would expect nothing less as we turn the calendar here soon to August, as again, the summer months are months that are typically pretty quiet for the market. Not a whole lot in terms of gains typically come during the summer months. But we've seen the market continue on its upward trend here over the course of the past 2 months, and now we're 4 months removed from the market bottom from March 23rd, and the S&P 500 has rallied over 40% during that time period. And so, a lot of stocks, a lot of companies have certainly come along with that ride, with big, large cap technology really being right there at the forefront. And so, but what we wanted to talk a little bit about today is not necessarily, rehashing a lot of those conversations, but something that we have seen of late here has been the U.S. dollar has been moving in the opposite direction as the general tide of the equity market has, to the extent that since its peak back in March of this year and later in March at 102.5, the U.S. dollar is off almost 9% from its high. And for a currency, for the dollar, that's a pretty big, pretty notable move. And the dollar moved into a negative trend back at $98 and has now fallen to the June 2018 low. And so not much, a move to 93 on the dollar would violate those lows, and really not much support to be seen on the chart until back in the lower 80s. And we mentioned the dollar as the dollar has a big impact on a number of different asset classes. When you go back historically and you look at not necessarily U.S. equities, that the U.S. equities don't really have any correlation to the trend in the dollar. If you look at during both rising and falling dollar environments, the S&P 500 has almost identical returns, both positive of about 15%. But there's some pretty big trends that are persistent underneath the surface during falling and rising dollar environments. And so if you look during falling dollar environments, so during environments where the dollar is weak, a couple of asset classes really that stand out are one, non-U.S. equities or international equities tend to perform much better when the dollar is weak. In both environments, the international equities tends to do well, or tends to have positive returns. But in a falling dollar environment, you tend to see a greater magnitude of performance during those falling dollar environments. So that's kind of the one big area. And then the other area is commodities at large, and in particular gold. And we certainly gold, silver has been in the news quite a bit here recently, but those are areas that tend to do very well while the dollar is falling, is declining, and we've seen the dollar declining here really and speeding up here over the past couple of months. So those are things to keep in mind. Those asset classes are generally offered a tailwind during falling dollar environments, and we've seen that show up when we look across the board at some of the rankings and the movements, in particular within some of the non-U.S. groups as well as some of the commodity groups.
Absolutely there, Jay. And like you said, moving over here to look at some of those rankings, this is going to be taking a look at the asset class group scores page that we have on the platform. It's going to be a page that ranks the 135 different asset classes, different areas in the market, all according to the fund scores of specific funds that are going to be included in each group. So there's 135 different groups that we'll classify classify ETFs and mutual funds into, and then take all of the funds that we classify in each group and rank them by the average score of the funds included within each group. So that scoring system that goes from 0 to 6, 0 being the worst, 6 being the best. Take each of the funds in each group, average together, give you an average score for the group as a whole. And those 135 different groups are really meant to represent your full investable universe, if you will, about areas you could potentially invest in, at least on the fund side of things. On this page, I'm going to, as a brief aside, in looking, we do have continued to see the money market percentile rank continue to decline over the past month or so here, coming in at a recent reading of 16.90%, so relatively low cash ranking among the rest of the groups, the rest of your investable universe. And the U.S. equity core percent rank continues to remain at elevated territory at a recent reading of 81.69%. Now, that's certainly not as high as it had gotten to in this recent market rally, but it's definitely quite a bit off of the lows in the 50s where we saw it get down to with the market decline there in March. But as you mentioned there, with the declining U.S. dollar, there's definitely some specific areas that we've seen some notable recent improvement. And one way to depict that on the page is by sorting the page by score direction instead of sorting the page by average score. So in doing so, you're going to be taking a look at the average directional move of that particular scores of each group, looking at the movement from a high or a low over the past 6-month time frame, which provides a more kind of near-term indication of what areas have showing some more significant upside in the near term, or on the flip side, what areas have shown some more significant declines on the near term. And so in looking at that page from the directional standpoint, the group with the highest score direction on that page is going to be precious metals. Looking there with an average score direction of 3.05 and a very high average score reading of 5.02. That high average score is going to rank it second out of the 135 different groups that we track here on the platform. But again, very high directional reading, and the only group that has an average directional reading above 3.0. And looking at some of the other areas we see high from a directional standpoint, we see basic materials also very high there with the average score direction of 2.75. And then you get into some of those international areas, like you mentioned, those international spaces as well that have tended to do better in the past when you get the declining dollar. Emerging markets diversified. China has been one area really the leader from a technical strength perspective among international equities throughout this market rally that we've seen, continuing to score very high on an average score basis at 4.44 and a very high score direction as well at 2.36 there. But then perhaps some more surprising international areas as well, looking at Latin America, still scoring in low field position at a ranking of 123rd out of the 135 groups that we see, with an average score of 2.28, but a high score direction as well, 2.13, showing a very significant move off of a very low score. So even though it's still scoring in low territory, it was certainly scoring much lower during the market decline there that we saw. And we've seen many areas within the Latin America space pick up the pace a little bit here over the past several weeks especially. But and notable improvement as well from India is another international country-specific group that has an average direction above 2.0 with a direction there of 2.05. Placing with an average score there of 2.89. So definitely seeing some of that carryover that you were talking about there, Jay, with the declining U.S. dollar going down to those lows from June of last year. Seeing some tailwind in some of these other rankings, especially from that directional standpoint, looking at that near-term pop in many of these groups that you would expect to be advancing a little bit with the declining dollar.
That's right. Yeah, I mean, precious metals, it's big move in the score direction, and you look at something like GLD, which is an ETF on gold specifically, and that has been in a positive trend for a number of years now. But here recently, you've seen some big move higher in that, taking gold prices up to all-time highs, specifically GLD. Moving up to $184, and that is continuing to move higher today, up to 100, hitting ultimately 186 earlier today. And you see very similar picture to silver. Silver has recently has made some big moves here recently, after moving back into a positive trend around 16.5, has now moved in the low 20s. And so while these things are overbought on a near-term basis, gold and silver alike, there are certainly areas that have seen notable improvements from a relative strength perspective, and that goes too for some of the precious metals stocks. I mean, these two, so SLV and GLD, are both ETFs that are backed by the physical metal. So SLV is backed by physical silver, and GLD is backed by physical gold. So when you're buying those, you're actually buying the metals themselves. There's other ways to gain exposure to the precious metals sector, and that's through individual names. So gold miners or silver companies that are in the precious metals business. Individual names out there, certainly. Also ETFs like GDX, which is a gold miners ETF. Similar type of pictures that you're seeing on the gold and silver charts as well. Strong technical scores. Overall trends are positive and continuing to hit new highs into overbought territory. So things are overbought near term, longer term strength, and trends are certainly positive for the precious metal space. But, at large, commodities in general have seen a tremendous amount of improvement. Precious metals been kind of at the forefront of some of that. But even with like crude oil specifically, and our chart CL forward / is the ticker symbol on our site, that has recently moved back into a positive trend at $42 a barrel after bottom, at one point back in May, the front month crude oil contracts actually turning negative at one point in time. And now here we are back at $42, crude back above $40 a barrel, recently moved to 42 to put the trend back to being positive. So, across the board, the metals, the energy, crude oil is the largest commodity in a number of just broad-based commodity indexes, especially those that are production weighted. That's going to be the largest. So crude oil is certainly a very, very important piece of many broader-based commodity funds, ETFs that are out there, more index-based ones. So that is, certainly for crude oil investors, for commodity investors, a positive picture for crude oil is certainly something that sounds good or looks good on its chart. It might, but for you and I, it might not be good because that might mean higher gasoline prices. But I guess if we're not going anywhere, so we're not using a whole lot of gas these days, are you?
Exactly. One of the benefits of quarantine, I guess, is that they don't have to pay quite as much attention to the gas hedging they might need to in the normal summer months, right?
That's right. Well, yeah, I mean, this is, commodities are certainly one of those areas that we mentioned at the beginning that are benefited by a weak dollar. But, international, as we saw improvement, international is another one of those areas that's benefited by a weak dollar as well.
Absolutely. And I mean, we've seen real specific improvement from the emerging market space, especially. I mean, China being that big bellwether that has led most of the international space and in the rally over the past few months here, playing a big part of that now, making up almost 40% of most of your broad emerging markets related funds. Taking a look at the broad emerging market fund, EEM, iShares Emerging Markets ETF, seeing 4 consecutive buy signals from EEM, going back up towards the multi-year highs that we saw there at 46 in January, climbing back up towards that, currently sitting at 44 on the chart, sitting in what looks to be more elevated positioning there, up on a little bit of a stem, but not necessarily where you're considered to be heavily overbought there, at an average weekly overbought oversold reading 66%. And again, a lot of that is in seeing China lead the international space higher. But another place that we've seen some more recent improvement has been in Latin America, as we mentioned there, and looking at that score directional moves on the asset class group scores page. Latin America was the only group down in the red zone, down below the 2.5 score that we saw up towards the top end of that directional ranking. And then looking at one of the bigger spaces within Latin America, obviously being Brazil, taking a look at the iShares MSCI Brazil ETF, ticker EWZ, I see a very similar kind of picture from a scoring perspective here. Pretty low fund score relative to at least what we would consider favorable, with a current score of 2.19 for EWZ. But a very positive score direction, very strong score direction of 2.11, showing a very a lot of strength since it bottoming out there in March. We saw the fund move to a near-term low at 2050 in March of this year, and then had a little bit of back and forth movement before continuing largely higher. And then it's most recently given 2 consecutive buy signals, recently occurring at 31.50. And with today's intraday action actually reversing back up into a column of X's, they currently sit there at the 33.50 point. So return to give a third consecutive buy signal at 34, and that movement to 34 would also potentially move it back to an overall positive trend. It's bumping right up against that longer-term bearish resistance line here. So it will be, and we see this reflected on some other Latin America-specific funds. Looking at FLN, the First Trust broader Latin America Alphadex fund, also bumping right up against its longer-term negative trend line. So it'll definitely be an interesting place to keep an eye out here. Continue to see that if we continue to see the dollar decline, and seeing some of these Latin America spaces start to break back through to positive trends, could certainly be an interesting place to monitor here as we head into the month of August.
Yeah, it's interesting, and you look at Brazil and their economy, and there's a pretty big weight in something like an EWZ towards the energy and materials theme. So so that is certainly in line with some of the strength that we're seeing across the board in the precious metals, the basic materials. We didn't mention specifically, but that one has seen notable improvement. Basic materials, that is, here recently in its overall score direction as well. So very interesting. We'll continue to watch and monitor the dollar. If we continue to see declines in the dollar, we're likely to continue to see some of these trends internationally and in alternative assets like the gold and silver type of areas. We're likely to continue to see those improve if the dollar continues to decline here. So with that said, as always, appreciate you joining us this week. Hope everybody's having a great summer, and look forward to talking to you next week. Thank you.